where the contact details are.
Great.
So I'll just post it when you talk.
Madeleine, are we using the same format as we did last time?
Yes. So the contact details. Can you remember the format?
Not really. Trying to remember now. Right. What do you want me to mention? We've got 3 minutes.
Just put it up again, what we discussed last time.
What?
No. How could you think that I could introduce anybody looking like this when you look like you do?
Who?
Larry.
You.
That's aimed at Larry.
Yeah, Larry, you should maybe just slip a tie on, and then you'll really, then we can really get impressed.
Oh, I take my jacket off. I'm on holiday. I live on an island, a big island.
Larry, last time you started it off, then handed over to Keith to
Yes.
say a bit about IVPD and then over to
Okay.
Paula. Okay.
It's recorded and there's a link for CPD points, right?
By the way, Madeleine, I haven't clicked on that CPD link. You're just going to need to do them for me.
You have to do it yourself, Keith. Come on now,
Give me
take
your
responsibility.
council number, I'll do it for you.
No, don't,
Really,
Madeleine.
the first
Absolutely
two's
not.
already been accredited. Yeah, but
It's already gone past. How can I click on it if it's already gone past?
no, we've put all 4 webinars in one form, so we'll just upload according to how people.
Okay,
attend.
perfect. Then I'll manage that. Thank you. Yes.
Okay, I'm going to open the room then. $11:59. Okay, great. Here we go.
Should we wait for a while? For people to enter, or do we just
Wait
start?
for a few more people to join.
Yeah, we are now live, so I see there's already a few participants in the room.
Oh,
Yeah,
okay.
it's steadily climbing. So let's just wait.
You can start, Larry. That's all good. You can start.
Hi, everyone. Welcome to IVPD Business Matters. My name is Dr. Larry van Niekerk. I'm one of the IVPD directors. This is one of a series of 4 webinars I produced for you. It is being recorded, so you can get CPD points. It's a real honor to welcome Paolo Lencioni. He's going to introduce himself. Every time I've listened to Paolo, I've learned more and more about veterinary business, specifically valuation. Tonight's webinar is a continuation on the valuation theme. Just before we do that, I'd like to hand over to Keith McWilliam, the chairman of the IVPD.
Good afternoon, everybody. Nice to have you all here. Just a quick summary of what we supplied last week. Our contacts with Nedbank are through medical banking. Please do not contact the normal Nedbank. You will not get service from them. Madeleine has posted on the webinar now the Nedbank contacts, and please use them if you have problems, or please contact either Madeleine or myself so that we can head you in the right direction. So please do that. One last thing, Moneyline, who run the IVPD Provident Fund, if you need to contact Brian Shear, who runs it, it's well worth having a chat to him if you do not have a Provident Fund in place for your staff. There have been previous discussions about somewhere along the way, the government regulating that we do need to all have Provident Funds in place for our staff. And it's something that you should rather do sooner than later. Without further ado, we're going to hand you over to Paulo. We always do the easy way. We get Paulo to introduce himself because he's far more fluent at doing that than Larry or I are. And Madeleine has also posted his CV on the webinar. Thanks very much, Paulo.
Thanks, Keith, and hi, everyone, and thanks to you guys for attending from South Africa. A good blast from the past for me because I was an honest but graduate. I think I graduated in 1996 as a vet and then worked as a vet for 11 years in the UK, had my own practice and then retrained as an accountant. And just by the way, there's nothing in this for me. I'm not going to sell you anything. It's just Larry, who is a very convincing individual who managed to convince me to present late at night here in Australia to you guys. So that you guys, he said you guys, needed some or wanted some, had an appetite for something around business valuations and practice performance metrics and what we see kind of in other parts of the world. So just briefly, now I work predominantly as an accountant. I'm a founder of an accounting firm in Australia that only deals exclusively with veterinary practices. We don't touch anything else. And we also do valuations for buys, sells, partnership disputes, all that sort of stuff. So we tend to value about one practice a week, about 60 practices we valued this year. And that's in Australia, New Zealand, Hong Kong, Singapore. So Asia Pacific is kind of where we work. So a bit of an apology. I won't be like the examples I've got aren't in rands, aren't in South African rands. But like you can literally like just add a zero, almost like the Italian lira, all the Italian lira was, and kind of then it'll make sense to you in terms of your amounts. But actually the concepts are very, very similar. So we'll start with a little refresh on what we did last time we presented, and it was really about the last webinar I presented was really about a real warning for you guys not to rely entirely on what your tax accounts are. Whatever your accountant produces for tax purposes is not the value or the profit that gets used when we estimate the value of your business. There's a number of adjustments that have to be made because the incentive of a tax accountant is to ideally make the profit look as low as possible, so you pay less tax. From a valuations perspective, it's a bit the opposite. You want to try and make the profit go as high as possible in an equitable, fair manner. And there's a lot of things that get removed or adjusted when we value a veterinary business. So I'm just going to rehash one of a simplified example I did last time, which is a very simple profit and loss statement of a veterinary practice. Say what would be effectively a two-vet veterinary practice here in Australia. And I'm going to keep the chat open just in case any questions come through, because I don't mind you guys asking me questions in the chat while I present. Larry will just keep an eye on the chat and just interrupt me if there's any questions. But anyway, for a two-vet practice in Australia, say for example, if this particular practice was being purchased or someone was interested in purchasing this practice, you can see there's sales of about $1.2 million. The cost of goods sold, which would be the cost of all the wholesalers, external laboratory fees, and cremations, about $200,000. Wages about $400,000, rent at $10,000, and then all the other expenses like electricity, staff amenities, CPD training, all that stuff around $300,000. And with that, in a classic profit and loss statement, we take all the sales, we subtract all the expenses, and we're left with a profit of $290,000. So I'll put that question to you guys. If you were going to be buying this practice, would there be any questions you would be asking the business owner about this very simple profit and loss statement? Would there be any highlights, any red flags, anything you would want to ask them? And just write that in the chat and make the chat to everyone, not just to the host. A little drop down says that says everyone. So change that to everyone and put in the chat if you guys can think of any things that you would ask this business owner before before you you proceeded to take his word that the profit is $290,000. Okay, whoa. Oh, well, that's Larry, you naughty boy. You know the answers to this already, right? Good. So Larry does listen to me, does listen to me a lot. He's a bit of a groupie. So Larry says, the first thing you would ask the business owner is your salary included in those wages? Okay, that would be one of the most important questions you would ask a business owner, because business owners do not take a commercial wage. They might take more, they might take less, depending what their personal tax position is. For example, if they have a spouse who earns a very, very high wage, they might not take a wage at all. So they might not take a commercial wage. So that would be one of the first things. And the other one is the rent market value, okay? Because very often veterinary business owners occupy their own property, and if they've fully paid off that property, they don't necessarily pay a commercial rent. But if you were to buy that practice from them and not buy the property, they would then want a commercial rent as a landlord. So we then have to rejig the profit and loss statement, replace whatever nominal amount they might have been paying themselves as rent with a real rent. And we've also got to replace the wages and include a commercial wage for the business owner. So in this particular example here, the business owner wasn't paying themselves a wage. So in Australia, the average wage for an experienced veterinary surgeon is around $140,000 for, say, a 36 to 38-hour week. I believe in South Africa, for an experienced veterinary surgeon, it's around the 1 million rand mark. It doesn't matter. This ports across quite simply to whichever country you're in. So in this particular example, we have to increase wages by $140,000, and then we get a real estate agent to appraise the property that the practice is working in, and we have to add $35,000 to rent. So suddenly, by increasing the wages by $140,000 and the rent by $35,000, we have to take that amount off the profit, because those are expenses that the new business owner would actually incur going forwards. So we've adjusted that. Now, the other thing that catches a lot of people out is very often medicos have associated entities. If they own a property, for example, they don't normally run or own the property out of the company they run the veterinary practice in, because of the risk component of that, a property being a high value asset. So they'll normally have a family trust or own the property personally. So when we ask this individual about their property trust and look to see their property trust financials, we then see that there's two wholesaler bills there. Provet there is just one of our biggest wholesalers in Australia. So we see two wholesaler bills there for $20,000 and an additional entry for administrative wages for $30,000. And these were expenses that were actually written in a different entity, but actually belong to the veterinary practice. So we've now got to take them out of the property trust and put them into the veterinary practice. And if we do that, we then have to add extra $30,000 to wages, an extra $20,000 to cost of goods sold, and then we are left with a profit of $65,000. So you can see all of a sudden what looked like a profit of $290,000 has now gone to a profit of $65,000. So this is a process called normalization. It's what valuers do all the time when they value businesses. It's not subjective. These changes are very objective, and all business valuers would actually make these exact changes I've shown you now. And that's basically a very brief summary of what we discussed at the last thing. Now, you don't have to be able to do this all yourself. I think what's important is you have to understand the concept of this, so you don't get caught out. We see a lot of veterinarians caught out in the buy-sell space where, you know, they might be young, they might be unsophisticated investors. It's the first practice they're buying, and they would pay, you know, a multiplier of that $290,000, and instead they should have only paid a multiplier on a profit of $65,000. So this is a very, very important concept that you have to understand. Now, for today, the next important concept I'm going to introduce you guys to is, we've looked now at the profit and loss statement, but there's something called a balance sheet also. And the balance sheet does come into play, but we didn't speak about it last time. Okay, so when we look at this, we ask ourselves, first of all, what assets is a valuer actually valuing when they actually look at the profit and loss statement and produce a valuation report? And the answer to that is they're just valuing the goodwill of the practice and the plant and equipment. Okay, and there's other parts to your business that come into play much later on down the track, which I will now explain in this webinar now. Okay, so here I'm seeing William's got a question here. Profit is 9%, 9.5% of turnover. This is a bit low. should be closer to 20 to 30%. Ideally, yes. In a well-managed practice, you want your profit to be running at about 20%. That's kind of our EBITDA score here, but a lot of practices don't. In Australia, actually, with that is the average profitability of a veterinary practice in Australia is only 14 to 15%. So it's not all roses here. And incidentally, doctor GP practices only run at about 9%. And Willem Schultheis, just say yes in the chat box. Did you used to lecture at Onderstepoort? Just say yes in there, and I'll look at that, because I used to have a lecturer called that name. You might not remember me if it's you. Okay, so what we have to do now is take the balance sheet comes into play, and I'm going to explain to you also then. We've adjusted the profit now to $65,000. We now have to apply a multiplier to that profit, and what does that multiplier also mean? Okay, so as veterinary business owners, and in fact any business owner, the common kind of shortcut is to have an adjusted profit produced by a valuer, and then there's, depending on where you are, what the market is like in your area, a multiplier is applied to that profit. So if you're looking in Australia for a well-run practice, the multiplier of $65,000 on that particular example would be $325,000. Now that is for goodwill, plant, and equipment. Okay, and I'll just make that clear all the way along, because other things come at play later on. If you're in another area, perhaps South Africa, you'd be looking at a 2 to 3 times multiplier. So that would be $130,000 for goodwill, plant, and equipment. And there were some people pretty upset, I think, last time about the difference, the disparity between Australia and South Africa around business multipliers. But I believe when I first came to Australia, I think practices were only going for 3 times multiplier. So understand also that the market does change with time. Okay, so what do the 2 and 5 times multipliers actually mean? They're actually just a shortcut. For me as an accountant and valuer, what they actually mean, and what all you have to do is you divide 100 by the multiplier you've used. So the 5 times multiplier, if I divide 100 by 5, it means that the buyer is expecting a 20% return on investment before tax. Now in Australia, that would be a pretty safe investment, like it would be safe as houses. It would mean that they could, as a buyer, they could pay themselves a commercial wage, they could pay off all their loans and the debt for purchasing the practice for the said value, and they would have some residual profit left. So in that position, they would be better off than being an employee. And the assumption is that the business will continue to perform at least as well as it did when we valued it. A 2 times multiplier, on the other hand, you divide 100 by 2, and it means that the buyer expects a 50% return on investment before tax. And the reason why you see a lower multiplier, higher expectation of return on investment in countries like South Africa. In Hong Kong now, we're seeing a very similar thing, because obviously the Chinese government is moving in, is because there's higher risk. And at higher risk, a buyer expects a higher return on investment, because there's a higher chance of something going wrong. Okay, so that's kind of a simplified thing as to what the multipliers are and where things are in the market. I have an opinion here, which I'm going to say now, around corporatization of veterinary practice. I do believe there is corporatization happening in South Africa. It happened extensively in the UK, where large companies took over veterinary practices, and there's an attempt to it happening in Australia now. And to me, if I was looking at corporatizing the veterinary industry, and having like 200 or 300, even 500 practices run and then listed on the stock market, I think a country like South Africa has a much better would have a much better result than a country like Australia. What we're seeing in the corporates in Australia is they're purchasing very high net profit margin practices for top dollar. They're paying sometimes 7, 8 times multiplier on profit. But the problem with that is once they own them, and the owners that were working there have to work there for about 3 years. Once those owners walk out, all the goodwill walks out the door with them, and these practices are crashing after about 6 to 7 years of corporate ownership. So the risk, because of the higher multiplier, because of the low risk in Australia, the corporates are actually struggling to maintain and keep their practices going for a long period of time. In South Africa, because they're effectively getting what might be very profitable businesses at a discounted value, they probably have a better chance of managing a corporate business. Be interesting to see what you guys have to say around that, but around corporates in South Africa. But my view is that because they're paying a discounted value, they might actually make a better go of it in a country like South Africa than in Australia. It's very, very difficult to run a big business in Australia if you pay top dollar for it. Okay, so let's go back to what the valuer has valued. And this is really important because people always assume that things all happen immediately, okay? But the average time from us doing a business valuation, looking at the profit and loss, adjusting the profit, and then applying the multiplier to the profit. So in that practice, say it was $320,000 that the goodwill, plant, and equipment was, we said what it was worth. The time from us doing that to the lawyers actually agreeing and settling on a contract, the average time is about 3 months, but it's not unusual to see 6 or 9 months, okay? So when we look at what a valuer has valued, this is in a nutshell what your business is, right? You have your pet owners, which is your goodwill. You will have money in your bank account. You may have a loan that you use to purchase some equipment and to do your business fit out. You may have a bill. This is actually an Australian wholesaler, a bill to CH2 or whichever wholesaler. So you may have money owing to a wholesaler. You'll have a whole lot of plant equipment, X-ray machines, drip stands, microscopes, pulse oximeters, all that stuff. You'll have stock sitting on your shelves. You may have a tax bill to pay. You'll have staff that will have leave owing. And you may have, I don't know how pension funds work in South Africa, but you may have pension fund money owing to your staff also, which is a component of their wage, right? But when we're valuing the business, all we are valuing on the first stage is the goodwill and the plant and equipment. All the other things can only come to play on the week when the contract settles, which I said on average is 3 months after we've done a valuation, can be 6 months, can be 9 months. Now, the goodwill and the plant and equipment are unlikely to change very much because there's not such a fluctuation in client numbers, for example, over 3 to 6 months. And any person who is imminently selling a business in 3 to 6 months is probably not going to buy an MRI machine at that stage. So the equipment won't, these two things won't change much. However, the money in the bank account will change. Loans might get paid down. Wholesaler bills are going to get paid and new ones are going to be created. Stock on the shelves can fluctuate a lot. There may be a tax bill owing at the time. There may not be a tax bill owing at the time of actual contract 3 months later. And staff may take leave and have cleared out their leave. So all that can happen is we do the initial stage for goodwill, plant, and equipment. And then on the week of sale of a business, the accountant might have to do what we call settlement accounts. So they reconcile all your accounts just like they would at the end of the tax year. And then they look at the balance sheet and then all these things, other things here that I haven't ticked, come into play. Now, what's important to understand here also is this thing is what we call a net asset adjustment. Only happens if the business is going to continue running out of exactly the same company that the seller is operating out of. Okay, if that's not happening, then we don't have to worry about these adjustments. So for example, if you are doing what we call a walk-in, walk-out sale, when we sell outright. So basically what happens is you're going to sell your business, another young vet's going to come in and take over the whole thing. Technically, what actually happens if you're actually operating your business out of a company called XYZ Vets Pty Limited, you keep that company called XYZ Pty Limited in your own name, you remain director, and the new buyer will open their own company called ABC Vets, and all they will do is transfer the goodwill and the plant and equipment into their new company. Okay, then they'll of course also want your stock. So you will do a stock take on the week of contract and say, okay, maybe there's $30,000 of stock or $50,000 of stock. And then that'll be added to the value the valuer said. And that's basically all you have to worry about, okay? Any bills owing to wholesalers, any tax bills, any money in the bank that you had in XYZ Pty Limited remains yours. Okay, so effectively, you don't have to worry about a huge net asset adjustment. However, if you are introducing a business partner, so you want to keep 50% of the shares, but you want to sell them 50% of the shares, then it's very, very different and it becomes a little bit more complicated. So when you're actually introducing a partner, or in some cases, when you want to keep the company running, if there's a corporate buyer, there might be reasons why they want to actually buy the shares of the company, or you might want them to do that. For example, you might actually get a better tax outcome, which sometimes happens in Australia. Then the valuation process is a little bit more complex, because in that case, all of these things come to play. What happens is, on the week of contract, this net asset adjustment has to be done. The reason why I bring this up, particularly if you're looking at selling your business, is it's one of the most common things we've seen scupper a buy-sell arrangement, because people think when a practice is valued at, say, $500,000 or $1 million or 5 million rand, they expect that is the money that's going to transfer hands. But suddenly, a week before contract, there's all this argy-barging between accountants and lawyers. They get a bit frightened. They don't understand the process, and they back out of the deal at the last minute. So this is just a heads up that this is completely normal if you are actually keeping the veterinary practice running out of your existing company. The new owners, or the new 50% owner, or the totally new corporate owner is going to get the clients, they're going to get the plant and equipment, they're going to get the stock, but there will still be some float left in the bank potentially. There will still be loans that company owes to banks for plant and equipment and fit outs. There will still be wholesaler bills sitting there that need to be paid off, and particularly loans and wholesaler bills and tax bills that are owing are going to then reduce the amount of money you're going to get, because they are going to become responsible for those, and you are no longer going to be responsible for them when you exit. Okay, does that make sense to everyone? The ultimate amount of money that you have as a seller is the same. Okay, all that happens in this example is you get paid less by the buyer. In the previous example that we had here, when you're selling outright, the buyer pays you more, but then you've still got to pay these bills off. Okay, and that's what people don't kind of get. Okay, so understand that there's a different process if you're selling outright or if it's a walk-in, walk-out sale. Okay, so here's kind of a very, very simple example of what this would look like. So I've done the valuation 3 months ago. We've said the practice is worth a certain amount in terms of goodwill, plant, and equipment. Then the week before contract, accountants do settlement accounts. They balance everything out just like they would before you have to complete your tax returns. And you say, okay, with this $100,000 stock on hand, well, that's extra. So I'm going to get that extra as a seller because the buyer's getting the stock on hand. There's $50,000. The buyer wants $50,000 float in the bank account. So they're going to pay me $50,000 extra because they're getting $50,000 that's in my bank account. Then there'll be money owed to you by pet owners, debtors, but only that's likely to be recoverable. Okay, they're not going to pay you for absolutely everything that's 3 or 4 years old. So say there's $5,000 there. I've crossed out plant and equipment because that's always on your balance sheet. Remember, I've already valued that 3 months ago. Goodwill, plant and equipment is what we're valuing 3 months prior. So these are good things. You're going to get $100,000, $50,000, $5,000. But then there's also bad things. There's things that your business owes and people that your business owes. So you might owe $100,000 to the bank for a fit out. You might have $10,000 of leave owed to staff. You might have a $20,000 tax bill outstanding, and that's the company that XYZ Pty Limited has a $20,000 tax bill. And you might have $20,000 owed to a wholesaler. So when we add and subtract all of those, we have $5,000 left. So in this case, it's happy days. The seller is actually going to get an extra $5,000, but it doesn't always play out that way, particularly if you have big loans on the balance sheet. Then it often goes the other way, and you might actually have a reduction in the money that changes hands. So simply put, in that example that we had, is if it was a 5 times multiplier and the practice was $325,000 for goodwill, plant and equipment and stock, we add goodwill, plant and equipment, we add an extra $5,000 as a net asset adjustment. If it was a 2 times multiplied, $130,000, we add an extra $5,000 as a net asset adjustment. Okay, so there is this net asset adjustment that happens where essentially all your assets and liabilities are added and subtracted, and then that changes the amount of money that physically gets transferred. The simple reason why it happens at the last minute is because all of those things can fluctuate so much from one day to the next that a valuer who's doing it 3 months prior cannot estimate what they are. Okay, so that's a very, very important part. I know it's a little bit of mouthful to take in. But again, from a conceptual perspective, understand that it's a walk-in, walk-out sale. It's not that complicated. It's a very, very simple. Net asset adjustment is just really the stock that's going to be valued at the last minute. If you are introducing a business partner, or you are having a buy that is structured in a manner that your existing company is going to carry on running the veterinary business and you're going to exit it as a shareholder and director, then there is going to be a much more complex net asset adjustment, and the money that changes hands might vary from what the valuer says. It's like there'll be an adjustment to what the valuation said a few months prior. Okay, so with that in mind, we'll go on to the next thing, which we're going to discuss today is we look now at EBITDA, or profit, earnings before tax, depreciation and amortization, as being the primary factor that influences what a practice is worth. Okay, we say in that other example, we said we'd adjusted the profit of that practice down to $65,000, and we multiplied that by 5 times in Australia, maybe 2 to 3 times in South Africa. Okay, and remember that that is probably the most important factor that's going to determine what a business is going to sell for. Because like I said before, when a buyer comes in to buy it and they assess their risk, what it proves to them once we've done a valuation is that they can pay off their loans, they can take themselves a commercial wage home, and there'll still be a little bit of residual profit left there, such that they are taking a bit more money than they would have otherwise as an employee. And that's what they need, because ultimately they're going to go through blood, sweat, and tears of running a business. They want to be slightly better off than an employee. So that EBITDA figure is very, very important. But some profitable practices, they might have a really, really high EBITDA, can be really, really difficult to sell. Now, we're not business brokers. We have an associated business broker in Australia who we work with. And we know that we value certain practices, and we know, because we've done a lot of them, we know that some practices are just outright hard to sell. Even though the business owner is making tons of money and an incoming buyer might make tons of money if they bought it, they're really, really hard to sell. Does anyone want to comment as to why that, have some guesses as to why that might be the case? And I've got some examples here. So if you could just put in the chat, why do you think some practices might just be really hard to sell? There's a very shy audience in South Africa there, Larry. I think the Australians know me better and they heckle me a lot more. All right. What have we got coming in on the chat there? Okay, location. Few would want the responsibility. Okay, the guys who've said location. Yeah, location. Location is everything. And many of you, I think, probably at this webinar are already business owners. You've already made the decision of where your practice is. But when we deal with younger veterinarians wanting to start up a veterinary practice, I say to them, the most important marketing decision you make when you start a veterinary business is not going to be your Google search engine optimization. It's going to be where you locate your practice. Okay, very, very important. Someone else said one-man practices notoriously difficult to sell. Bang on the money. One-man practices are notoriously difficult to sell. And why? Actually, that's a lie. I'll come back to the one-man practice story. I would say one-man practices in remote locations are notoriously difficult to sell. But there is a risk factor associated with one-man practices, which I'll talk about now. So thanks, guys. Those were actually fantastic answers. All right. So let's start off with that one-man practice being notoriously difficult to sell. This is what we call key person dependency. And of course, when someone buys a one-man practice, the first thing at the top of their mind is the relationship of all these pet owners is going to be intimately associated with one person in the building. What is going to happen with that relationship when that person leaves the business? So with that, the key person dependency factor, the way we factor it in evaluation is if the business owner, the person leaving or selling, invoices more than 50% of the annual revenue, then we say that practice is key person dependency, and we would actually say it's a higher risk, therefore we would apply a lower multiplier. So instead of, say, using 5, we would bring it down to 4.5 or 4 with key person dependency. Now, that said, we have been across a lot of buys and sells, and we have actually found, like, if a young vet comes to me and wants to buy a one-man practice where I think there's a key person dependency, and that clinician is very, very ready to retire and got to the point where they've been running their practice, kind of as a lifestyle business and perhaps not worrying too much about the profitability and the higher levels of services to clients, those are in fact fantastic practices for younger vets to purchase because they get them at a slight discount because the profitability is not that high, and then they can actually come in and actually do a lot more dentals, blood testing, all that kind of stuff. And we've actually had a couple, more than one actually now, where in the first year under new ownership, revenue actually grew by about 60%. So I would never put off a younger vet from buying a one vet practice. It depends on the profile of that practice. It's more of a problem if you have a one vet practice and it's running a 30% profit margin. Then my question to the younger vet would be, are you as good as that person who owns a business now? Okay. Number of vets, which kind of fits in with key person dependency. We know for a fact that when corporates are buying veterinary practices, if they're going to apply a very high multiplier of 7 times or 8 times multiplier on profit, it has to be more than a 3 full-time vet equivalent practice. And their rationale around that revolves around key person dependency. They certainly don't have boots on the ground. They're not physically, the owners of the business are no longer physically involved on site anymore because they're a corporate. So they're very reliant on the existing senior vets in that business, and they don't like it just being one person, because if something happens to that person, then it's obviously going to hamper their investment. Okay, Michelle, they're saying people not wanting all the responsibility of having a practice, as one's job is already very stressful, and thus now being an owner can increase the stress. Tell me about it. It's just as bad running an accounting firm. Sometimes I ask myself why I would want to be a business owner. It's quite easy to also point the finger at like millennials and say they're not as tough as us Gen Xers used to be. However, we have seen more in Australia, we have hands-on dealt with more startup veterinary businesses than ever now, run by much younger vets than us. And those that do have an appetite for business and are business savvy are actually incredibly good. So it is actually, yeah, we can be a bit generationalist and look at that, but we've seen some fantastic startups this year. We also see people who buy a business who shouldn't. And are not business owner material. All right. Location. Okay, I put location at number 3, but location is so important. It's a really big deal with location. Mixed skills, and I'll go into some of these now in the later slides, but in practices where mixed skills are required or where specialist skills are required is also a problem, and I'll discuss a bit of that. Another thing to watch out for very carefully in your business if you're looking at selling it, I don't know if it can be a psychological issue around buyers, but if your practice is quite profitable, but it's had declining revenue and customer numbers for a year or two, buyers are very nervous of practices with declining numbers because they worry maybe it's a big competitor, or people moving out of an area and something wrong with the economics of that particular area. So that's one of the big deals we look at. And then poor price position, which I'll actually discuss with you. So we look at pricing of veterinary practices when we value them, and make a call on an adjustment to the multiplier depending on where the pricing is pitched. Okay, so key person dependency we've kind of discussed. It's a big deal. Any practice that has a single individual invoicing more than 50% of the revenue in that business, and then that is the person who's going to be exiting on the sale, is going to be high risk. Now, this is not unusual, and because we do a lot of business advisory work and a lot of ongoing consulting with vets, it's not unusual for us to see a veterinary practice with 4 vets and the business owner is still invoicing 50% of the revenue. Okay, and then the junior vets are really just there supporting that very experienced, very effective surgeon. And our advice to, if you are in that situation, is you've actually got to try and wean that dependency off. So it's something we work over about 3 to 4 years with our clients to try and get that person to reduce their billing volume and actually get one of the younger vets to actually start stepping up and doing more of the billing. It's actually very important in a sales scenario if you want to retire. Location. Okay, you might be somewhere beautiful, and there might be heaps and heaps of animals there, even with mixed practice and remote practice. There might be heaps of clients there. But the problem with the veterinary profession when it comes to buyers and sells is that it's probably one of the smallest professions in the world. And we in Australia know what remote means. Like, you think things are remote in South Africa, and they can be. It can 10 times worse in Australia, okay, because there's a big, massive desert in the middle. And Australians have what we call fringe affinity, where they just all live on the coastline. Whereas South Africans are much bolder. They will actually go to Johannesburg, right? And they'll go in the middle because there's gold there. They'll all go live there. In Australia, something quite different happens. Is if there's mining, like a mining center somewhere, like Mount Isa, what they do is they live on the coast with their, and all their families on the coast, and they fly in, fly out. Okay, they will not live away from the ocean. So what happens is we have these towns where there's a lot of people, it's transient population, there's a lot of pets there too, and the practices are very, very busy, but there's not a single vet other than the vet who's selling to sell to. You know, there's just, the veterinary profession is small. Like I think there's about 5 to 10 times more dentists in any country than there are vets, and probably like 50 times more GPs. So if you're a dentist or a GP, just statistically, even if you're fairly remote, there will be someone in that area who'll be looking to buy a practice. If you're a vet, it can be notoriously difficult. So if your practice is in a remote area where there's not many other vets living there, no matter how good it is, it can be really, really difficult to sell. And there's nothing I can tell you to make it sell. We've had practices that that have been with the business broker we know now that are very good practices, have been there for 3 years, 4 years, really good practices, engaged customer base, good standards of care, good quality medicine being practiced. And there's simply not any senior vets who want to go live there forever. So they managed to get fly in, fly out, temporary, transient staff working for them, but there's no one who wants to live there. So location is a big deal. So we would value that practice at a 5 times multiplier. It ticks all the boxes. It's got good client base. It's got good profitability, but the broker lists it, and unfortunately the price has to come down because there's no one else available there. So they have to try and encourage someone to buy it as a good deal. All right, mixed skills, or the other extreme of specialists. Okay, so this is an interesting one. We have definitely found a trend in younger veterinarians now that they don't want to do everything. So they either want to be a small animal vet or they want to be a large animal vet. So in that sense, we know for a fact that although it might be very, very profitable, a mixed veterinary practice that does both small animals and large animals can actually be harder to sell than a veterinary practice that is specialist, large animal or small animal only. On the other extreme, funnily enough, and this is kind of a sad thing, or someone said that I am a millennial, go the millennials, you guys are fantastic, okay? Like what millennials do is when they start up a veterinary practice, they immediately have like 500 clients because they are so networked on social media, where us Gen Xers used to sit there and wait for someone to come in the door. These guys have got people coming in the door from day one, right? Okay, that's our millennial setup practice, fantastic. Okay, so going back to the mixed skill set, the other extreme of veterinary specialists. Veterinaries, like we've had to value a number of veterinary specialist practices, and it's actually really difficult to explain or to get them to understand that they've done all this extra study, and theoretically they should be able to sell their business for more, but it comes back down to the same problem as the location problem. Is when you're a veterinary specialist, and say you're an eye specialist or an orthopedic specialist, the number of people who can physically buy that practice is actually reduced by a factor of 10. So there is simply fewer buyers for specialist practices than there are for GP practices. So we know that specialist practice, although in theory you think, okay, this is highly profitable, money can be running at 30 to 40% profit margin, there's actually no one who can actually come in and fill in those skills. So most veterinary specialist practices often groom internal people and build them up to take over from an older specialist, is generally how the buy-sell goes. But on the open market, it's very, very difficult to find a specialist of that skill in that particular area. It can be very, very hard. All right, so that's the mixed skills, or the other extreme of just being a specialist. That can make practices very, very hard to sell. The declining revenue in customers, I think it speaks for itself. You know, a buyer will look at that and say, oh, you know, the practice looks good, but I can see the revenue's been declining for 3 years. Customer base has been declining for 3 years. Our usual approach to that is let's investigate why that's happening, because often if you can find the answer, it doesn't really, it's not quite as frightening. You might find in some cases it is truly itself. And like we've had these cases before where it's a business owner who's just, got older, got some chronic illness, and just wants to cut back a little bit on work. And we know when that practice sells, it's someone who's healthier and more enthusiastic, it'll build up again. So as long as that's the case, it's fine. But if there's other issues around, like we had one in a recent mining area with a big port build, where the then movement out of people after the big building project of a port up near Townsville, Gladstone area. The population density there was just like literally halving in the next, projected to halve in the next 4 or 5 years. Then that's obviously going to be a problem. All right, price position. Now, price positioning is an interesting thing, right? And a bit questionable. So we, unfortunately, as valuers, have to make a call sometimes on this. We have 3 valuers in the building who are effectively specialist veterinary valuers. And we understand also we never make these decisions alone. In any valuation, two valuers will look at a valuation, not just one, because often the decisions made around the multiplier that's going to be used warrants some discussion. And then we still always have a meeting with the client to explore a bit more as to, and discuss why we came to that value, and there might be things we'll change after that meeting. But generally, and this is very generally, practices that are cheap and charge low prices tend to be less attractive than ones who do high quality medicine, regardless of the profitability. The reason being is this is a generational thing. When generationally you look at the incoming vets, they are more well-trained and there's more modern diagnostics that they're more accustomed to, and they generally want to practice a high level of practice. So for them, it can be tough coming into a practice that offers a discounted type service. So we do price benchmarking on practices, and when we do value a practice, we look at their headline prices effectively. If those prices are very low, we would consider applying a very slightly lower multiplier. And the main rationale around that would be you've probably selected for a cheaper client base than a competitor practice who may be selecting for a better customer base. This is probably one of the most subjective decisions we make around valuations. Okay, so with that, I'm going to go on to the next, just give you guys an example of what we do with practices now. Now, say someone wants to sell, and this isn't necessarily only if you want to sell. This is for all of you, because one of the biggest problems we've come across this year is like, how far can you push your prices without having too much customer pushback. So when I came to this price position slide, I said, okay, let's do this, because this is a good way to beef up your profitability of your practice if you're going to sell. Alternatively, if you wanting to keep your practice, it's something you should be thinking about doing anyway. So what we've been doing for the last, so when COVID actually came about, there was this big pet boom, and then there was this complete boom in veterinary wages. So veterinary wages globally started to go higher and higher. People wanted more wages. There's increased pressures on cost of living. And we could see that wages as a percentage of turnover in our customer practices was starting to increase. And for us, like 43% wages as a percentage of turnover is the kind of the spot you want to be. You don't want to be much higher than that. So our response to that was, you can only do 2 things. You can either keep your staff working at the same pace and charge more money, or you can make your staff work harder. Now, the second one, making your staff work harder with all the mental health problems we're seeing, people leaving the industry, etc., we didn't feel that was the appropriate action. So we embarked on a crusade of strategic price increases for our clients. This is how we do them, okay? Now, we have software that does that, like kind of does this for us, but you can do it without any special software, right? First thing we do is, and this is actually a real example from an Australian practice. Okay, so kind of in your mind, kind of add a 0 if you're thinking South African. But what we do is we bring up a list of everything they have sold in the last 365 days. Okay, so in this particular case, their biggest ticket item was inhalation anesthetics, where they did $218,000. Their second biggest item was consultations, $155,000 in consultation fees. Okay, so you just order it in decreasing order of how much money it's made you. Okay, then you ask yourself, is it a headline price or not? Is it a price that a customer can compare easily with other practices or is it not? Okay, and you highlight the headline prices, and I've actually done them here in yellow. Okay, HLP means headline price. Okay, so effectively, the one thing I learned working across multiple industries, because I worked as a vet, then I worked as a software developer, then I worked as an accountant, is one of the real bonuses you have as a vet is, on average, any vet will invoice over 1,000 different items in a single year. So you have such a diverse number of services and products that you sell that the consumer actually can't compare them. There's effectively a handful of things they can compare: your consultation price, your repeat consultation price, your spays, your desexings, castrates. They can compare. If you use something like ProHeart, SR12, and those injectable items, they can compare. And any long-term medications that they can look at, like Medicam, they can look at online and online things. That's probably your most sensitive headline price. The rest is kind of open season, because it's very, very hard for them to get a comparative from another practice without really having a consultation and having another vet look at the pet. So in this particular case, I said, okay, well, let's not touch any of these headline prices. We don't have to change them, okay? But then let's do a significantly higher than CPI increase to the other prices. Okay, so what we do then is, in this particular case, we said, okay, this is how we're going to change them, all right? So I'm going to increase all of these other ones by 10%, which is significantly higher than CPI at the time. And I know exactly the volume that they're selling every year. So I just multiply that by 10%, and I can see in this case, it's going to make me an extra $21,000. This is going to make an extra $7,000. That one's going to make me an extra $4,700. So I can see, assuming that the volume of work done by this practice is going to be exactly the same as it was the previous year, and it might not be, but assuming it's going to be roughly the same, I can then project and calculate how much these price increases are going to make, and any extra money you make as a price increase is profit. Okay, it's total profit. So with these price increases, the prediction would be that this would have been $556,000 extra profit for this practice by just touching those prices. And incidentally, when we do this, we only look at the top 30 things in this list. Like, we don't go across all 1,000 items, because 90% of the return you will get from price increases will happen on the first 30 items, on the top 30 items you sell. Everything else becomes negligible, okay? I do it that way. Then the other thing I do is I then take my spreadsheet and I sort it, instead of by the price, the amount of money I've made, I sort it by quantity to see if there's any high volume products that I sell that a very small change will give me a big impact or big bang for my buck. And again, I still have my headline prices marked off, but these are my high volume fees. A lot of them I've changed already, but there's a couple here that I think, and this is one I did, right? So they were charging a hospital waste levy, like an additional fee on their general anesthetics. A lot of veterinary practices do this. They were charging a surgical procedures pack. They were using meloxicam anti-inflammatory injection extensively, and because it was injectable, it's not that headline price, because they were just using it post-operatively. And then they were using a couple of Serenia injection as an injectable antibiotic a lot. So don't change the price of the tablets, but the injectable, if you use it frequently in your consults, then you can increase the price of that. And then they were doing a lot of fluorescein tests and emptying anal sacs, which they were pricing individually. So I said, okay, let's just increase that one by $10, that one by $10, that one by $5, and just make a small dollar increase to each one of those. And knowing the volume they did, that was an extra $27,000. Okay, so then what they do is they make these price changes, and honestly, not a single, like, I've done this now across over 100 practices, like not a single client notices, not a single pet owner notices the price changes. And then, so collectively between that, what was that? The previous one was 56,000 and $27,000, $80,000 in terms of profitability. Yeah, and if you're looking at selling your practice, if you can put that on your bottom line, multiply it by 2 or 3 times. All right, because that's the practice is done on profitability. So if you can do that and be aggressive with your price increases, just pre-sale in a very strategic manner, you can get a lot of bang for your buck. Okay, so that's kind of the strategic pricing piece, which I threw in there around pricing, and like why low prices is one of the things we look at, kind of a justification around that. So the way we were actually doing this is when I actually added what the price increases were going to be, I actually wanted to, we used to set it such that the wages then came back down to 43% of turnover. So basically what we were doing is we were offsetting any wage increases with strategic price increases. And with that, across from 2019 to now, the average EBITDA of our customer base, I think it peaked at 20.1% and it's sitting at 19.3% at the moment, even though we're facing a looming recession. And actually from 2023 to 2024 financial year, which has just finished for us now in Australia, there was no change. It was at 19%, 19.5% in 2023, and it was at 19.2% in 2024. So in spite of the doom and gloom kind of statistics going around, the profitability of our customer base has been maintained. And this is one of the big reasons why we very, very proactively got involved with setting the prices for our customers in this manner. Okay, so that puts me at 51 minutes, Larry. I think that's what I've got for you guys today. I think that's what I got. Yep, there we go. There's my lovely doggies doing a bow, and I'm happy to take any questions. Jacobus, you've said, is there a fair markup on drugs? So basically what we do with our customer base is if it's a it might be different in South Africa, but if it's a prescription medication, then the markup is 100%. In other words, they double it. So this is the case where, say, for example, a patient comes in with a pyoderma and you have to break open a box of Clavulox or Baytril or whatever, and you give them a number of tablets of that product with a dispensing label on it. The markup generally is 100%. So whatever you get it from the wholesaler, veterinary practices will double it. That's the standard. But we are very, very cautious with what we call chronic medications. So those are things that the client comes in repeatedly and regularly for, like arthritis medications, cardiac medications are classic ones. And they can actually go online and actually shop for these products online. So they can immediately get a price comparative of these. And we say to our clients, you have to price yourself within the market for these products. In Australia, it seems to be okay to mark them up by 50%. But in some areas, some practices, it only touches really, if you look at the big ticket items, it only touches about 7 or 8 drugs. So it's not a big deal, but you can afford to have even a lower markdown on that and a lower dispensing fee on those particular products too. So you just have to be aware of those products, because that is actually, when I listed your headline prices, paradoxically, people think, oh, like our desexing or our vaccination fees are probably our most sensitive price. In fact, the prices that cause the most complaints in veterinary practices is when someone comes in to buy a bottle of arthritis medication for their dog and it goes up by 3 Rand. And they said, because they come in every month or every 2 months to buy, they're acutely aware of a price change. And that is actually the one that causes the most complaints. And paradoxically, your dispensing of those products is probably contributes the least to your profitability of your business. Right. Does the method change significantly for a specialist, but obviously much smaller buyer market? Yeah, definitely. So that's what I said about the specialist practice. You have a much smaller buyer market. So paradoxically, so what we've done as valuation firm, actually, we don't apply a different multiplier to specialist practices. We still apply the same multiplier, but we've got another large valuer in Australia who we actually have to jointly do valuations with in cases of divorce and things like that, because we can't represent an existing client if they're getting divorced. And we've always had this conundrum as to what to do with specialist practice, because you can put them on the market at a really, really high price. But if there's no specialists of that speciality in the area wanting to buy a practice, your market is literally 1/10 of what it would be for a GP veterinary practice. So it's much, much harder. And for specialists generally, though, fortunately, a lot of the sales actually seem to eventuate from someone inside coming up and purchasing the practice. So in a lot of the cases when we do those valuations, there already is someone lined up, fortunately, to purchase those practices. Question from question 8, does plant refer to stock? No. So basically, when we do the valuation and you apply a multiplier to profit, the assumption is that value that we apply is for all your client goodwill and the plant and equipment. Okay, that's a valuation methodology called future maintainable earnings. And the reason why it's all lumped in together is the assumption is that you require that plant and equipment to make that profit. If that plant and equipment wasn't there, then you wouldn't be able to make the profit. So it's kind of fixed in future maintainable earnings valuations, which are the preferred way for valuing practices. But we get that question a lot because people say, okay, the value has valued the practice at like 1 million or 2 million rand, but now we still have another 500,000 rand of plant and equipment. Surely we should get extra money for that. No, based on this valuation methodology where there's a multiplier on profit, the plant and equipment is included in the valuer's valuation, but not the stock. So anything that is like tablets, disposables, bandages, plates and screws for orthopedic equipment, stuff that is disposable has to be added on in the week of settlement. But plant and equipment like x-ray machines, surgical tables, theatre lights, fit out of the practice and rooms and things, that's all included in the multiplier of the profit. Okay, that's a good question because that confuses a lot of people. And just another thing on that plant and equipment thing, if you're thinking of selling your practice, one of the worst mistakes you can make is to purchase some really, really expensive equipment like within 18 months or 24 months of you selling. Because when a valuer applies that valuation methodology, which is what is usually used for service type businesses, you are not going to get a return on that brand new piece of equipment. So generally our advice to people is if you're looking at selling, don't buy something. We're actually very fair as valuers. What we actually do is if a business has bought a significant piece of equipment 12 months prior to selling, we actually make a add back for it. So we actually do try and catch that. We've had situations where some people have bought something like an MRI machine, okay, and then they want to introduce a partner a year later, and we say, oh well, when we value a business, we're actually looking at 3 years of profit. So like that MRI machine hasn't really had the chance to make the profit, so we actually add it back to the profit as a depreciated value. So if they paid, say, $1 million Australian for that machine, then we will say, okay, well, we're going to add back $800,000 and depreciate $200,000. But we're actually one of the only valuers that will do that. Okay. How do you separate specialist reputation from goodwill, especially if linked to historic reputation? So again, that's the conundrum of key person dependency and the problems around a specialist practice. Because again, as a specialist, you're actually not marketing or delivering service business to pet owner. You're a business to business, much like we are as an accountant. We only deal with businesses. Your clients are actually the referring veterinary practices, and this is a really big problem for specialist practice, which again brings me back to the best way to deal with this veterinary specialist practice is to bring someone in from below to gradually buy in that business so that the relationship with the neighboring vet and referring veterinary practices can be built up. Because yes, my suspicion would be if I have a young specialist who wants to purchase an established specialist practice, for a few $1 million, and that specialist is going to walk out straight after the deal and they've got a good relationship with all the neighboring practices, my question would be like, do you think that's safe for you to do? Now, I'm not going to change my multiplier because I actually can't think of a formula that I can apply in terms of changing multiplier. So I'll still give it a multiplier. But if I'm representing them, I'll say think very carefully about this, because when that person leaves, do you have a relationship with those other practices, or are you good enough that you can immediately build up a relationship with those other practices? Okay. So is that it? Looks like the questions are better this week, Larry. Everyone seems to be a bit more. I think maybe they're warming up to me now. They're not quite as frightened of me, guys. So this has been a fantastic audience. You guys have been absolutely great.
Thanks so much, Paolo. There were as many watching this time as there were last time, which is great. And I just loved your idea about strategic pricing and all the factors that affect the sale of a practice and the patience that's required in the
and
process.
don't underestimate the strategic pricing. It was overly simplistic for us when we looked at it and said, like, are people going to think this is silly? But it's one of the key things that over the last 3 to 4 years have maintained our customers' profitability. So I thought it was a good thing to show guys around that. It's something you can apply quite easily without specialist software, because I think we're able to report on all your sales like that in any practice management software.
And the specialist practice, is that similar to the key person dependency concept?
Yeah. Yeah. So that is, I say, that's been a conundrum. And David Sharp, who's the other accountant who does a lot of valuations, and we have to throw ideas because, like, I'd like to say we only value in Australia, but it can't be like that because when we have like partnership disputes or family court issues around divorces where two vets are getting divorced, like we need another valuer in the mix. So we actually have to compare notes, and he has exactly the same conundrum around. So we discuss these things, and like outside of our firm, he has the same conundrum with specialist practices. Like he feels like it's right to apply the same multiplier, not a lower multiplier to them, but it can be very hard to find the right person to fill those boots.
Well, I've taken lots of screenshots and also recorded this in Otter AI, so I've made lots of notes. So thank you so much. It's always so valuable. Really, really appreciate it.
Thanks, guys, and thanks for being a fantastic audience. That was a great. I really enjoyed that one.
And the fact
Thanks,
that you're
Keith.
doing this
I can see Keith is
when it's late.
still watching intently.
Yeah.
He hasn't fallen
Thanks
asleep.
so much, Paul. It's such a privilege having a fellow veterinarian go through things like this. I think that it helps us relate to it far better. I've just gained so much from just these two talks that you've given, and I can't wait for the third and the fourth one. So thank you so much.
And I still can't see whether Willem Schultheiss was actually my herd health lecturer.
Yes, he was.
Yes.
Was he?
Was. He said yes.
Fantastic. All right.
Thanks so much, fella. Thank you.
Thanks a lot, guys. So we'll catch up again for the
Next
next
time.
one, and I will be here. Don't worry.